Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Chris Verrone of Strategas, a bad company, writing, for all the concerns about tariff policy, the market still seems more worried about growth than inflation. Chris joins us now for more. Chris, good morning.
It's great to be here, John.
Kept going over your quote from the last time we spoke.
Yeah.
Do lower yields speak to some kind of economic weakness, or do they support cyclicality in the equity market? Is the equity market answering that question now?
Well, yeah, I think that's what's been so important about this move lower in yields over the last month or so, is it has not recatalyzed the leadership from the market's more cyclical corners. I think that's a very big change in the character of what we've seen, frankly, over the last 18 months, where when you would get relief in yields, you would, re-entertain this broadening of the market, this cyclical or small cap leadership, and you just have not seen that here to any great extent. So what we ask is, are lower yields actually more reflective of maybe something sinister with the economy moving forward? And listen, I think the jury's still out on that. Financials are still pretty good here. Credit's still relatively calm, but it would be silly not to even entertain that here.
Does credit confirm? Was going to be the next question. What do you see in credit in high yield, in the more speculative parts of fixed income?
It's still remarkably benign here. That's why I don't want to get too over my skis or too carried away with the growth scare call or the market's putting in some big top call, because at the end of the day, if something really sinister is out there, you're going to see it through the lens of where you typically see it. Weaker financials, weaker banks, weaker credit. And we can't check those boxes yet. So we're alert here. We put out a note last week, some reasons for caution. I just don't want to get too over my skis with that view yet until you begin to see changes in financials and credit, which you have not gotten yet.
Is there a larger takeaway here? And John was laughing at me the other day when I said, actually, if you get a good auction, that could be a bad thing too right now. And he's like, it's a bad auction, it's terrible. If it's a good auction, it's terrible. How much more bearish can you get? But is it telling of where valuations are in risk assets that a rally into bonds could be viewed more for the negative? And if you get a sell-off in bonds, that also could be some sort of hit to valuations at these levels.
Well, I'll make a couple points. I think, Lisa, what you described there is simply a game of expectations, and I think we entered 2025 with the expectations game very full domestically and very light elsewhere. And what have we seen to start the year here? We've seen Europe and China, I think, easily exceed low expectations, while we've struggled here domestically to kind of meet the bar of high valuation, maybe deteriorating technicals, and all the like. So that expectations juxtaposition was really, I thought, the crux going into 25, and I think it remains one going forward. When you look at the inflation impetus behind tariffs or immigration, the places where I would expect to see it, higher bond yields, you're just not seeing it. So again, it comes back to the question, maybe the market has more growth concerns on its mind than it does inflation. One last big point here. While we've seen cyclicality weaken domestically, I think it's important that we have not seen that elsewhere. Cyclicality has not been extinguished globally. I mean, cyclicality is alive and well in Europe. It's really alive and well in Asia and China here. So it seems like, if anything, cyclicality has just migrated to other parts of the world. What do Europe and China have in common? They have much more accommodative central bankers right now. I think that's the big difference.
I think you nailed it when you started by saying it's been a game of expectations, and a lot of this is just simply the money moving to places where it seems that evaluations maybe are a little less extreme. Have we already overdone that? I mean, is that basically what we've seen to date? And now any further decline in yields, any further deterioration in equities has to come on true evidence of really true weakness in the U.S. versus just simply a rejiggering of capital flows?
You know, I think we sit here, 10-year yields went out at 425 yesterday. They're maybe 430 this morning. The 2-year average in yields is right about here, about 420. So basically, the last 2 years, you've made no progress. For as much as you want to take credit for yields lower here, the reality is no one's really made any money on either side. It's been a range. So I think at the end of the day, where's the bottom end of that range? Somewhere around 390, 380. I think underneath that, then you'd really begin to say, whoa, wait a second. What is the market really messaging about the economy here? So I think we're okay here. I think we're in some range. The market's digesting these expectations. What we don't want to see is the internals get any worse. We're sitting here with 60, 65% of stocks above the 200-day moving average. Don't want to see that much under 50%. That turns a split market into a bad market.
What you described, though, at the equity level, Europe versus the United States, China versus the United States, is also taking place at the fixed income level, which I find really interesting. We closed out last year, and 10-year government bond yields in America are climbing. In China, they're cratering. They're rolling over aggressively. And if you look at the charts to start the year, it's like we flipped. What explains that story?
Yeah, I think really important change there. And, you know, we've been very much in this camp that what was beginning to play out in China over the last year was very reflective of what 2008, 2009 looked like here domestically, where you were in this financial crisis and you just couldn't get stabilization until particularly the short end of the bond market stabilized. We've now seen that in China. I mean, two-year yields in China are up 50, 55 basis points over the last 5 or 6 weeks. I think that is essential to really changing the tide and changing the narrative. Remember, you've had these kind of fits and starts of rallies in China over the last year, but this is the first one where bond yields have actually gone up. That, I think, is a really important change. Also, look at the leadership in China. Discretionary is trouncing staples. Financials have broken out. Tech and semis are your leadership. It is a really clean leadership setup in China. I think it's suggestive of the market saying we're past the worst of the economic recession there.
It's a massive sentiment shift backed up by higher bond yields. Stateside, we've got this big dislocation going on in the equity market. The Mag 7 down 10% from all-time highs in December. What do you and the team tell clients to do with that now? What's the approach to tech?
So when you kind of take them one by one, and you know, I'll say this as someone who's not a particularly level-sensitive investor or analyst. I like to think more about the character of a market or what the leadership looks like. But I think this is a year where you do have to be very level-sensitive because this Mag 7 is not monolithic anymore. And you know, you look at NVIDIA, I mean, up modestly after what seemed like good numbers. That always raises an eyebrow to me when you can't respond to good numbers. But the reality is, it's a stock that's been dead money for 7 or 8 months. It really has not made a new high since about June. I mean, there was a fractional new high late last year, but really has not made a new high since June. I think as long as that's under 140, 144, it's probably the same story, kind of dead money here. When you look at Mag 7 or just large cap tech broadly, I think the other big story, though, is it peaked relative to the S&P the exact same day that dollar-yen peaked, July 10th of 2024. So to think these two things are not related, I think, would be silly. I mean, what's been a bigger driver of flow, east to west, than yen carry over the last decade? So to the degree that's changed, I think it's important.
That's exactly where I wanted to go. And how much is this in tandem with the fact that the dollar's weakened versus strengthened so far? How much do you see a stickiness to that reversal in flows? This idea that countries that used to be huge investors in the U.S. suddenly are seeing more to favor at home?
Yeah, I mean, what's the first rule that you learn in this business is capital goes where capital is treated best. And I think for a long time when the interest rate was fixed or suppressed, that rule was thrown out the window. That rule's back. And the fact that, I mean, look at Japanese 2-year yields or Japanese 10-year yields, I think they tell you the whole story. We're going to get more from the BOJ. I think the BOJ is going to surprise on the hawkish side. I think dollar yen is telling us that. But not just dollar yen. Look at every yen pair, right? Sterling yen, Aussie yen, Euro yen, you have put a major, major bottom in yen. So again, what does stronger yen mean going forward? I think less money moving east to west. Where does that impact? Well, what's been the biggest receiver of these flows over the last decade? So I don't think these things are entirely coincident. I do think there's some causality here as well.
We've been building up a dollar long for the best part of a decade plus. Dollar-denominated assets, and part of that story has been big tech and a Mag 7.
And that's the reason why the idea that we're talking about the dollar yen and how that coheres with the peak that we saw in Magnificent Seven is really important to me. I keep thinking about the credit pockets that the Japanese investors, CLOs, collateralized loan obligations, that Japanese investors are some of the biggest investors in. What does this do to potential dislocations down the pike? Really interesting.
Hey, Chris, smart as always. You're one of the best. Appreciate it. Chris Verrone there of Strategas. Torsten Slok of Apollo writing, the consensus expects total Deutsche-related job cuts to be 300,000. However, studies show that for every federal employee, there are 2 contractors. As a result, layoffs could potentially be closer to 1 million. Torsten joins us now for more. Torsten, good morning.
Good morning.
Haven't seen austerity for a while in this country. Are we about to see it?
Well, I think there are 2 important dimensions for markets of this. First of all, if the consensus estimates are right, and there are various numbers out there, but if we do see layoffs of around 300,000, that raises the first question, namely, is that a big number or a small number? Total employment in the US is about 160 million. So in that context, 300,000 is not a lot. Total number of unemployed is about 7 million. In that context, 300,000 is not really a lot. And the total number of people who change jobs every month is about 5 million. So in that context, it's not really a lot. But if we do take into account that suddenly also contracts are now being cancelled, and for every federal employee, there are 2 contractors, maybe then we could have another 600,000 that also could be impacted. So first, which is a number at 8:30, it becomes important to think about what would the implications be if we do see numbers in the 500,000 to a million in terms of layoffs. The second thing is also that if we now start thinking about, well, if there are in total about 3 million federal workers, and there are, again, 2 contractors, that's 6 million contractors, that brings you to 9 million people, and therefore potentially 9 million families that are now being impacted by potentially having the risk of layoffs. So that's why the numbers we got earlier this week for consumer confidence could potentially be a reflection that a lot of people are now being impacted by the risk of potentially seeing layoffs, and that may be why consumer confidence took such a significant hit earlier this week.
You know the longer-term hope. The hope is that as the federal government steps out, the private sector will step in and we increase the dynamism of the American economy over time. That's the destination. How painful is this journey going to be?
Well, so that's why any adjustment in any economy, when you take people out of one sector, government, transportation, healthcare, whatever sector it is you want to change as a politician, if you take them out and you want to reallocate them to another sector, absolutely, it does involve periods of unemployment. It potentially also involves people who do not have the skills to go into the other sectors that you want to bring them into. So yes, any adjustment in any economy would be involving some pain, in this case in the form of a higher unemployment rate.
I'm going to ask you a question that you asked this morning. Sentiment bad, hard data good. How long can it continue? So
the answer to that, of course, is that the incoming data, as you talk about, of course, all the time at the moment, is really strong. The number of people flying on airplanes is strong. The number of people going to Broadway shows is strong. Spending on credit cards is strong. CapEx outlook by corporates is also strong. But how long time can we have this uncertainty about both consumer confidence being weak and also policy uncertainty being so elevated and potentially for a more extended period? And the answer to that is that at some point you begin to worry about that it will impact hiring decisions. They will impact spending decisions by companies. So the answer to your question, Lisa, is at 8:30 and potentially also already as soon as next week when we get the employment report, we will begin to figure out, is this uncertainty just talk and uncertainty, or is it something that actually will begin to impact spending decisions by businesses and by households?
And this really is the key question heading into the remainder of the year. You were really strong about the idea that inflation wasn't coming down as quickly as people expected last year. And you were saying that essentially you didn't see the need for all of the cuts that we saw last year that led to the 10-year yield rising. Is that the same thing here amid all of this uncertainty, or do you think that the rally that we're seeing in bonds reflects a great weakness that could be longer lasting?
It is still the case, because if you really think about what's going on, we are turning towards a world with more segmentation. This is not only the US. We had the German elections on Sunday, and segmentation means that countries are essentially saying we are no longer interested in importing as many goods, and if we do import them, they have to be more expensive. That's inflationary. Also, generally speaking, there's also a drive towards saying we're not interested in immigration. That means that that's also inflationary, in particular for wages. And industrial policies in different countries are also now different. Different countries have different interests. That also basically means less competition, which also means more inflation. So on a number of different fronts, you can both have at the same time higher inflation and weaker growth, which is a definition of stagflation. It's a stagflationary shock when you see inflation going up and growth slowing down. And that just happens to be the backdrop for the conversation that we're having in markets at the moment.
Is the Fed cutting or hiking into that?
Well, of course, the Fed now has the choice in the dual mandate to figure out how much weight do we want to put on the slowing growth and how much weight do we want to put on inflation sticking higher. So far, more recently, they have certainly been more worried about the inflation side of the dual mandate. But if growth does slow more meaningfully, if the unemployment rate potentially already at 8:30 today and definitely Friday next week and the following months begins to go up, I do think the Fed will begin to put more weight on the growth risks with the argument that that potentially will eventually drag inflation inflation down. But it's a very difficult spot for having stagflation as the input into the Fed decision making.
Sounds like you're making a bit of a change, though, a bit of a turn.
Absolutely, because we're getting worried about the challenges coming from initiatives, not only in the US, but globally, in terms of what's coming from politicians, in terms of the restrictions on immigration, what's happening with tariffs, and also industrial policies that, generally speaking, again, are things that are inflationary.
Do you think tax cuts by the end of the year can change that conversation?
So I'll come back by the end of the year and we'll have that discussion at that time. But I think that what's, of course, most important now is that the initial policies that have come out on the table are inflationary, namely tariffs moving higher and also potentially something being done across the board towards different countries. And the more that we have the risk that we will both have higher prices and less sales, the more markets should be preparing themselves for the risk that a stagflationary scenario might be playing out.
Torsten Slok of Apollo. Torsten, lots to think about. Appreciate it, sir. Thank you. This hour with equities pushing higher after Nvidia's mixed earnings report. Chadha of Deutsche Bank still optimistic, looking for the S&P 500 to end the year at 7K. Binky joins us now for more. Binky, good morning.
Good morning.
Give us a reason to be optimistic. Let's start there.
Let's talk a little bit about the confidence issue that we were talking about. Sure. And the pullback basically in both measures that we have of consumer confidence. I mean, the points that, I would note is confidence actually not a very good indicator or driver basically of spending, and you only need to look at the last prior 2 years when confidence was low and spending was great. You could argue, and I think it's an open question as to whether the decline in consumer confidence, it does impact at the end of the day some of the spending on big ticket items, but that's sort of still out there is the way I would put it. But there isn't a robust relationship with overall spending. So it might just be more about rotation. But on consumer confidence, I would argue that, it does tend to have an impact on presidential job approval ratings. We also saw that over the last 2 years. So it does matter. But I would argue bigger picture for equities, what matters is the business cycle. And that's, in our view, what's much more important is really CEO confidence. And here, the clock's been ticking rather fast, basically, so we actually don't have good readings on CEO confidence from the typical providers. I mean, they're dated. That's all.
You track earnings calls, though, so what are they saying on the calls?
Exactly, and that's what I was going to get into. So every quarter we write a report about what companies are saying, and the last one is called, and it's a quote from a company, living in a climate, basically, of uncertain optimism. So the optimism still outweighs the uncertainty. But that, of course, can change. But, bigger picture, if you take a look at the S&P 500 since the election, so it's almost 4 months now, we've been in a very, very, very tight range. It's plus minus less than 2% on either side. So very sharp, very furious moves, but really going nowhere. And so I would say the best explanation over the last 4 months of why we are up one day is because we were down yesterday, and why we are down today is because we were up. Yeah, I mean, that's what the price action basically says.
Is this how the client calls go, Ben?
And so,
check out yesterday.
So you look at where we closed yesterday, right at the middle of the range.
Hold on a second. You said
we can talk a lot about that what's driving every tick, but that's not kind of like normally what we do. We were just kind of doing that because it's such a tight range.
So let's take this a step further. You said that we're in an environment of uncertainty, and that seems to be what you're hearing on a lot of these calls. How long does it have to be where this environment of uncertainty persists and this level of uncertainty about forward-looking policy before you start to question your 7,000 price target on the S&P?
Yeah, so, first I would say we've been in a very, very tight range for almost 4 months, but you just take one step further back and you look at basically the S&P coming out of the October 2022 lows. We're actually in the middle of that channel. So the big picture hasn't changed yet. And that's a very, very, very steep channel is the way that I would put it. That's 23-24% at an annual rate. Obviously, if we continue to go sideways, at some point we will break the lower end of the channel. And that's sort of, April sometime, so there is still some time. And I think about the uncertainty issue, it's really about the cumulative impact of that uncertainty over time. So far, I would say, limited impacts. But of course, if you continue along like this, you're very vulnerable to negative shocks because, that's where we are. But what I would also say is one of the things that's basically keeping us in the range, I mean, the issues or concerns that the market has that we've been talking about, I would argue is sort of capping the upside. If you think about this market from a demand-supply point of view, this is a market where, in the absence of any new news, the market is going to go up. So you want an optimistic take. There's three elements of demand-supply. There's changes in positioning, which is coming down because of the uncertainty, but it's still overweight. You have flows that have basically continued. So if I take a look at the last 5 days in the U.S., lots of market jitters.
Hold on
25 billion in inflows. And we just had earnings at 15% year on year, and so that's where the buybacks are coming from. So in the absence of news, this market flows or rolls up is the way I would put it.
What you just said was really interesting, this idea that actually the uncertainty might be dampening the upside that we otherwise would be seeing.
Yes.
And that this market would be substantially higher if there was more certainty around some of the policy going forward. Are you saying that you reject the idea that the index level cannot go up significantly or to that 7,000 level because of the big tech dominance and the fact that that trade is over? Do you reject that, and you think that those could lead, and the reason why there is pessimism there is also tied to this uncertainty and this lack of conviction?
No, I think this is, it's not even a pullback. We haven't had a 5% pullback since August of last year. We're just flat, right?
But is there something going on in the internals that gets your attention? Do you see a growth scare warming up in any way, shape or form?
There is clearly, so again, this morning we are up. Last couple of days we were down, and so we are sort of doing intraday analysis.
Cyclicals versus defensive the last few weeks.
Bond yields down, equities down, which is what we saw. That's telling you basically that the market is concerned about growth because that's classic reaction to or market response to growth concerns. If you look at cyclicals versus defensives, it's the same reading. So there is clearly, some concern basically about growth. How big it is and how far it goes, it's an open question. I think the cycle has been very, very strong and is likely to remain strong. I think big changes in policy are a risk rather than our baseline view.
So market weight or equal weight? Which is your preference?
Equal weight, but that's simply because, positioning in mega cap growth and tech is still on the higher side. Growth is slowing just a little bit, not as much as we expected, but positioning is still too high for the kind of growth that we're getting. So it's vulnerable, somewhat vulnerable, I would say.
You're stripping out the muscle of big tech by doing that, and big tech is a place where we have had a pullback on a Mag 7 of as much as 10% from record highs. Does that not get your interest? Is that not interesting to you?
It is definitely interesting and it's definitely important, but it's in line with our thesis, so I don't, quote unquote, worry about
That's not a place where you think people should be?
I think it's still a bit early because positioning is high and growth is slowing, and positioning is, in line with sort of mega cap growth in tech continuing where it has, and arguably even accelerating, which we think is very unlikely.
Binky, it's good to see you, as always. Looking for 7K on the S&P 500. Binky Chadha there of Deutsche Bank. Joining us now to extend the conversation, Lauren Saidel Baker of ITR Economics. Lauren, welcome to the programme. Let's just recap the economic data. I'm sure you looked over some of it and heard the commentary from Mike McKee. What do you think?
Overall, no change to the outlook. This is kind of business as usual. No change to the GDP numbers. Growth is still slowing, but staying positive. So I do see these jobless numbers as a little bit of a hindrance. Again, as you just said, 1 week does not make a trend. Even 1 month does not make a trend. But we're getting that continued story of a little bit of directional deterioration in the labor market. But coming from such an incredibly tight starting point, we had this room to lose.
Lauren, we've seen the economic data soften, though. The soft data has got softer. softer. The survey data on the consumer, we saw that in you, Mitch, last Friday, saw it from the conference board earlier this week. How much attention do you pay for those numbers? And typically when you start to see them weaken like that, do you see it bleed into the hard data eventually?
Consumer sentiment data, I pay almost no attention to. What we see right now, especially from the Michigan data, is that it just diverges so much by Republican or Democrat, how I personally feel about my own inflation rate, right? Do I own my home or do I see my rents going up? So consumer sentiment is a notoriously terrible leading indicator. What I'm more focused on is something like CEO sentiment, and all of those surveys are showing more optimism, showing higher growth expectations for this year, showing more demand to be hiring, especially in the second half of this year. So I think for the more reliable leading indicators, that's where we still do see green shoots. It's just going to be muddling through the political noise in the short term on the consumer front.
Just to give some perspective, the 242,000 of the initial jobless claims that were reported was in tandem last seen on December 6th, and then previously seen much higher than that in October. So these numbers have been jumping around, Lauren, to your point. That said, when it comes to policy changes, we were speaking with Torsten Slok of Apollo, and he was noting that for every federal employee, there are 2 contractors that also lose their jobs. Are you expecting a significant footprint in these reports that really stem from some of the DOGE efforts in D.C.?
Significant is the key word there. I don't see that happening, at least yet. There's so much uncertainty, even with the reported numbers of, DOGE's self-reported savings have come under question. So I think the grand economic story is that there are still skills gaps, right? Especially on the manufacturing and the construction front. Maybe some of these other sectors like federal workers, like tech, that's where we do see a little bit more laxness in the labor market. But generally, this is still a tight market. We still see a lot of opportunity from that kind of core or median U.S. consumer. So we'll watch very closely, but we do need some people, at least, at work in the federal government for it to keep on turning.
Lauren, one other thing that Torsten Slok was saying is that all of what we're getting right now, the muddle, is setting up a stagflationary-like environment, and that you could get a slowing in growth at the same time that you get a pop at inflation. And I'm looking at some of the numbers, and I understand that they're backward-looking and that they're revisions, but if you take a look at core PCE prices in the fourth quarter GDP, they were revised upwards, 2.7% from the initially reported 2.5%. I just wonder at what point you start to see inflation concerns bleed into some of the data and then, in turn, into markets.
I do see inflation concerns. We'll get the new PCE data tomorrow, and that one's going to be very closely watched because, as I keep saying, 1 month does not make a trend, but does 2 months, does 3 months? We've started to see this relatively sustained inflation, a little bit more to the upside of what the market has expected. So I fully expect inflation to be coming back, especially by the second half of this year, but I think that timing might be bleeding a little bit earlier in some of these key categories that are really pressuring our consumer.
Lauren, appreciate your time. Still constructive on a consumer for the moment. Lauren Saidel Baker there of ITR Economics.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.